welcome to this carrier update brought to you by Parfleet. I'm here with the one, the only Thomas Wasson. Thomas, good morning.
Good morning.
See, we have a map.
Definitely have a map. Happy Monday, everybody. Looking at the map right now, we kind of have a situation where relative calm in terms of things not going up and down as much, but we're still in a situation, especially in like Kansas City, as well as parts of Omaha, Nebraska. We've got some downward movement on that. And so as we're going to see in the next few charts, we're going to have a lot of movement relative to volume. The name of the game still is the downward trends in volume. And so, other than parts of the Sun Belt, which, we're looking at below, hovering right over below 10% rejections, the story right now at the moment nationwide is the northern parts of the country are still experiencing much higher than expected tender rejections, as well as parts of the Northeast and Atlantic coast, with some falling in parts of Savannah, Jacksonville, and Baltimore markets. So we're going to kick it over to chart number 2 real quick. And so what we're looking at here is, this is pretty much the theme for the past 30 days. So outbound tender volumes as well as rejections are still trending downward. This is a 30-day snapshot, and so what we see is we're down to 16.1% nationwide, which is pretty impressive. I mean, I'd still get yelled at if my outbound tender rejections with a customer were at 16%, but it's a lot better than it was at, let's say, 19%. So, incremental progress in ways of if you're trying to get something moved. The cool thing to look at right now is look at the movement down. We're down to 13,700 basis points. We came from 15,000. And so, we're talking about freight markets, stock markets, all markets. This is still quite a bit. We're still seeing a decline. So what's getting impacted first? Spot rates, just because of the fraction of the market that spot operates on. 70% of all volumes are contracted tenders, and so we do see this outsized influence. Kicking it over to chart 3 real quick. What does this mean? Well, what we have here is a combination of equipment orders and truckstop.com 7-day moving averages. That's a mouthful, I know, but truckstop spot rates, TLDR. So, interestingly enough, if you look over here in the top right corner, you notice that spot rates they're taking kind of a downward nosedive at the moment, $3.45 per mile all in. So, I thought about how fuel prices would impact this. We're still seeing falling spot rates because macro trends. It's going down. Secondly, if you look at the bottom part of the chart, truck orders. This is from ACT Research, wonderful people. They have wonderful data, and what we're looking at is 17,515 new orders. The problem is, if you notice, spot rates are still high, the orders are going down, so production is constrained. In a typical non-supply chain disrupted environment, the inverse would happen. As spot rates go up, more people order trucks to gain and become a new entrant in the market or expand to reap the rewards of the gravy train. Well, right now the gravy train has no coal, and so we can't get enough trucks into the market, so it's still having an impact. Keep an eye on volumes is the key. Kicking it over to the next chart here. Try to sneak in 1 or 2 more charts if I can. We have a few more. There's bonus charts. Just keep an eye out for the next carry updates. I threw 2 more maps in just as a Monday surprise. So, diesel truck stop prices. We have the DOE. It's, you notice the bar kind of stops a little bit. Well, it's once a week. So tomorrow or later today, we should have some data coming in. This is very important because as you see, the actual full bar here on our mountain is stuck at $5.05. That is the actual price paid for diesel at the pump. It's leveled off. And so we talked about the past week, I talked about impact of rising fuel prices. When they go up really fast, it puts carriers at a disadvantage. The DOE has to catch up, just like we're seeing now. But when the DOE does catch up and fuel prices go down, there's the potential for a windfall where you're able to reap more difference between the lower price at the pump and the higher price that you're getting reimbursed if you have a fuel surcharge. So there's a lot of stuff to keep an eye on at the moment.
Yeah, a lot of stuff. And Thomas, I think you hit the nail right on the head. Like, especially if you're a new entrant trying to get into this market, trying to get into this space. Maybe you've been on the sidelines for a while, you've been a part of other operations, but I couldn't imagine jumping in now, especially after truck orders really were awful going in, and now we're seeing all these other headwinds really kind of piling in as well.
It's really hard, and this is going to impact buying strategies for carriers. Normally, in a good environment, you want to get lease owner operators, try to get them in as much of that older equipment as possible. But when the older equipment is still needing to be used, it's harder for carriers to offset the costs by trying to resell their equipment to a driver base. It's harder for newer carriers to get in the market, to even buy the equipment to get in. And by the way, once you buy it, not only is it older, but if it breaks, good luck trying to get it fixed.
That's the other big part, that maintenance aspect to it. I mean, it's just so many levels to this, and that's really where I kind of get caught up is like, wow, you look at this headline stories, but all these underlying trends are really impactful as well. Thomas, thank you so much for this update. Looking forward to those bonus maps that you were talking about a little bit later. Stay tuned because we're going to be right back with more Freight Waves Now after this short break.